small business owners, did you know that the capital gains exemption is not a gimme? Welcome to Tea at Taxevity, where you get insights from insiders who make life better, our many clients and friends. My name is Pramod Sharma, and our guest today is Mark Goodfield, who is the blogger at the Blunt Bean Counter, and he also won the award for the best blog in North America on tax from Plutus. Welcome, Mark.
Thank you. Glad to be here.
Now, Mark, when you're not blogging and winning awards, what do you spend your time doing?
I'm actually the managing partner and tax partner at an accounting firm called Cunningham LLP. We specialize in dealing with owner-managers, and my job is to maximize their wealth and minimize their tax.
And that's a great combination.
Hopefully.
Now, I've got to ask you about your blogging first. When did you get started?
Got started in September of 2010. We had a retreat with the partners, and we had a marketing specialist come in, and we got basically heck that none of us were properly using social media. And I like to write, so I said, hey, I'll write a blog. How hard could that be? Little did I know how much time and how hard it is to do. So I started up writing a blog, and I started in September of 2010, and my first blog had, I think, 3 people read it. One my mother, one my wife, and one somebody who got there by accident. And
so you mean you didn't even read your own blog post?
No,
you could have had 4.
Yeah, exactly. And really I had, at that time, I had read some investment blogs and a couple sports blogs, but I really had no clue what financial blogs really entailed. Mm-hmm. And so I went in pretty blind, and after a while I got to understand, what was expected and what you had to do to get it marketed. But it was, I went on a sort of a dare, and it grew from there.
Okay, well, it's great that you started that, because there aren't a lot of accounting blogs, and I find that you have this knack of explaining complicated topics in ways that are semi-understandable, and we'll use your expertise today as we talk about the capital gains exemption. Now, how do you find the time to do your blogging?
Especially at the start, it was very time intensive to get it up. I blogged more. To get my blog known, I had to make contact with other bloggers, newspaper reporters, so there was a lot of time up front. Now I try to do it a little bit at work if I have time, and usually I'll do it on the weekend, but it's easily, depending on the week, between 5 to 7 hours of time between writing future blogs and current blogs and answering comments on my blogs, etc.
Okay, that's interesting, because I find it similar. I've been blogging since 2007, and I'm embarrassed to say how long it takes to write a blog post. So I tell people typically 3 to 4 hours. So it sounds like less than half a day, but it's the truth is it's probably closer to 5 to 7 if you try to do it right.
Yes, and I think, I don't know about you. Actually, I could write a lot of them in basically 45 minutes to an hour, but mm-hmm. You then come back and leave it for a couple of weeks, review it, and especially with tax or with insurance, where it is somewhat technical sometimes, you want to make sure it's right, so you do a little bit of research to make sure everything is technically correct. So I do try, though, at the end of the day to write in my wife gives me heck I should write in plain English, so I do try to write in plain English, and I also try to write with a little bit of a sarcastic and humor style, because who the heck wants to read an account? It's pretty boring to start with. So I try to provide some information in plain language and add a little bit of sarcasm and humor to make it easier to read.
And yes, and because that has nothing to do with your actual personality, you've had to go out and change yourself to add those elements.
Exactly. I'm an accountant. I'm boring, and no one wants to speak to me. So I have a fake persona on my blog. Okay,
and this Plutus Award, how did you get nominated for it?
From what I understand, bloggers vote across Canada and the United States on the nominees. And then there's a committee that selects the winner.
Okay, and it's terrific that we have the winner with us today.
Well, it's nice. It's nice to know people appreciate your blog, and as we just spoke, you spend lots of time doing it, so it's a nice honor.
Mm-hmm. And today we're focusing on the capital gains exemption, and let's start off by making it really simple. What is a capital gain?
So a capital gain is a transaction where you sell a capital item and have a profit on it. So it could be a stock. You have Bell Canada that you bought for $20, you sell for $40, you have a $20 gain. it's a capital gain. It could be real estate that you bought for a couple $100,000, sell for $300,000, and you have a $100,000 capital gain. But it's not quite as simple as that. Often, what people perceive to be capital gains, Revenue Canada perceives to be income gains and adventures in the nature of trade, and therefore it's very highly litigated. So it's a bit of a loaded question, but for typically you would consider a capital gain to be a property you sold for a profit, and that profit is capital as opposed to income.
Okay, and how does a capital gain get taxed?
So capital gains are taxed at 50% of the gain, and that's the advantage of the capital gain. If a gain was income, it'd be taxed at a high rate of approximately anywhere from 46 to 50%, depending on the province you live in, whereas a capital gain is taxed more at 23%, one half of that amount. So you definitely want to characterize gains you have as capital if possible.
And dividends fall somewhere in between in terms of
dividends
taxation?
are sort of depending on your rate, somewhere in a 33 to 35, 6, 7% rate, and income again is at 46 to sort of 50% depending where you live.
Okay, now governments love tax. Why do they give a break on capital gains?
Capital gains, I guess from a policy point of view, is that you're risking your capital to invest in typically, it could be in companies or real estate, but by investing in, let's say, a company, you're helping the economy grow by letting giving that company capital to grow over time, hire people, and pay more taxes to the government. I'm sure the initial policy was to create jobs and have the economy grow, and therefore they give you the tax incentive.
Okay. Now, what is this capital gains exemption?
So when you own a small business, there's something called the capital gains exemption that right now is at $800,000, and it's going to be indexed for inflation over time. And if you meet certain criteria at the time of sale, $800,000 of your capital gain will be exempt. So if you sell your company for $2 million, $800,000 of that will not be taxed. So you'll only be taxed on a capital gain of $1.2 million. So again, at the capital gains rate, you're potentially saving $170,000 or so by having that capital gains exemption.
Oh, that's quite a bit then.
Yes.
And I've heard that there are ways to multiply the capital gain by having other family members use it somehow. How does that work?
Correct. So either when you incorporate a company to start with, you may have your spouse own that company to start with, so you'd have, you'd multiply it by 2, so you have $160,000. When you get into fancier planning, we sometimes use family trusts. The family trusts allow your children to possibly, or your parents to be involved in the company. You would typically use what's called a discretionary trust, so you as the owner still have a little bit of control on how it gets allocated, but you can multiply it by 5 times, so you got $4 million of capital gains exemption. Now, the downside to that is if you have one of your children as a beneficiary of the trust and you allocate the capital gain out to them, legally it's their money, so you would have to make a decision whether you wanted to allocate the full capital gain out to them. But for a lot of my clients who are high net worth, they say we can use this capital gains exemption to help them maybe buy their first house, and it's a way to get some money out tax-free potentially on the sale of a business to help your child start off with a house.
Okay, I've heard of, I'm not an accountant, but I've heard of capital gains exemptions mentioned many times, and it sounds like a really obvious thing that people should be using. Are there any pitfalls or surprises that occur when people are using capital gains exemptions?
Yes, the criteria to get the $800,000 capital gains exemption is really complex and detailed, and most people just think, well, hey, I start my company, I sell my shares, I get the capital gains exemption, but it's not quite that easy. There's asset tests, holding period tests, you have to qualify as a small business corporation, and it's way beyond what you want to hear in this interview, but quickly, for example, you would have to hold the shares typically for 24 months. Over a 24-month period, 50% of the assets would have to be used in what they call an active corporation, and at the time of sale, basically you have to have 90% of your assets used in that corporation. So if you have a lot of passive assets, and what I mean by passive is cash, stocks, real estate, you can easily fall offside. And also a lot of people they may have a holding company. The holding company could now accumulate a large amount of these passive assets and therefore put the company offside for the purposes of the capital gains exemption.
Okay, it's interesting you say that, because from my understanding of business is like you start off a small business and then it starts becoming successful. So that's your operating company. And then what you do is you set up a holding company so that if your operating company gets sued, then there's really nothing to sue because the assets are in this holding company. And then it just seems that the holding company is the ideal structure. But I think you have written, because you've written a blog post about capital gains exemptions, it seems that using a holding company can interfere with getting a capital gains exemption?
Correct. So the holding company is your typical strategy to creditor proof any cash you've earned in your operating company. You've been successful, you have a lot of cash in it, you don't want to be sued and have that cash subject to creditors. So in general, assuming certain criteria are met, you can pay that cash up to your holding company tax-free and have it out of harm's way. Mm-hmm. The problem with that is if you actually think you could sell your company for a fair amount of cash down the road, you've now put a company in the middle that is starting to accumulate sort of what I call these passive assets, investments, cash, real estate, and may put you offside for the capital gains exemption. And so if I came to you and said, okay, I want to buy your company, and you have a holding company in the middle, you have to sell your shares of the holding company because that's what owns the operating company. So if the holding company has a lot of assets that put you offside, it may put you offside the capital gains exemption. Now, if I know if you come to me and say, Mark, I'm planning on selling my business in 2 years, we have time to sort of what we call purify that holdco, try and move some of the assets out of it and get them out of harm's way, so to speak, from a perspective of the capital gains exemption. But if somebody walks up to you tomorrow and say, wow, I really want to buy Taxevity and I'm willing to give you $10 million, and you say, okay, where do I sign? Mm-hmm. If you have a lot of money in your holding company, you may be offside the capital gains exemption and you may not be able to get the capital gains exemption.
Now, so someone wants to buy the company for $10 million and say there's $2 million in the holding company. What happens then? So
if you don't have time to purify those assets and the sale has to happen very quickly, you're most likely going to be offside because you only have 80% of your assets in an active small business at that point in time, and you would not qualify most likely for the capital gains exemption.
Okay, and then the consequence is a lot more tax.
Exactly. So 23% tax on $800,000, and if you have 4 people that could potentially multiply that exemption, it's a big number, $500,000-$600,000.
Okay, wow, there are a lot of nuances here. Now, how well do you find small business owners understand the capital gains exemption rules?
They honestly have very limited understanding. People are aware from the media and from their accountants that they have this capital gains exemption. So whenever I meet somebody, or especially when I get a new client, they say, oh, I'm going to get the capital gains exemption. I said, well, you're not necessarily getting the capital gains exemption. You are going to have to meet a whole bunch of complex criteria. And that's just those criteria. There's a whole bunch of sort of underlying things that could affect that. If you had claimed what's called an allowable business investment loss, where you had invested in another small Canadian company and that company unfortunately went bankrupt, and you made a claim on your tax return, that reduces it, potentially your capital gains exemption. There's something called the cumulative net investment loss account, which basically tracks the amount of investment income you've had less investment costs. So if for example, you basically had a investment loan that's been costing you $10,000 a year for 8 years, you could potentially have $80,000 negative balance in this cumulative net investment loss that could potentially restrict the capital gains exemption. There's a whole bunch of other things too, but it's a really very complicated calculation, and people think it's basically you have a corporation, you get $800,000 capital gains exemption, but it's far from that.
Yeah, I certainly have that simplified interpretation myself. Now, the reason for all these details is that for the government to reduce the number of people who can take advantage of the capital gains exemption, or are they trying to be fair in some other way that doesn't seem obvious to us?
I think what the capital gains exemption is meant for basically a small Canadian company that has grown over time and become, gained significant wealth, and during that time, because it's grown, it's employed a whole bunch of people and helped the Canadian economy by purchasing goods. So if you've accumulated a whole bunch of cash and investments, they're saying, well, that isn't really the intention. They do want you to obviously become profitable and pay tax.
Right.
But if you're using this now, your holding company or your operating company, to just accumulate a whole bunch of investment assets, that's not what they really want. They don't like investment assets in corporations. So I think it's really, they're happy that they want to encourage the capital gains exemption, but if you're using your corporations to basically save a layer of tax by having an investment company, then that sort of gets them slightly unhappy.
Okay, yeah, that makes sense. Now, what's your key message in our discussion?
I think the message is that the capital gains exemption is not a gimme. So you have to understand that you may have to plan for this exemption. So if you're thinking of selling your company, you really have to speak to your accountant or your tax lawyer, or whoever you deal with, in advance and say, okay, I'm getting to a point where it's time to sell, or it's time for some kind of succession plan. I need to make sure that at that point in time, my companies are going to qualify for the capital gains exemption. So do we have to purify this company or do something to make sure I'm going to be on side at that point in time? And if you're really looking for potential use of that capital gains exemption, the real key is that it's really an ongoing review situation, and always make sure you're going to be on site or know what you're going to do, or give yourself enough time to qualify to get the exemption.
And when you speak about enough time, how many years in advance of a sale should someone do the planning?
Because you have to hold the shares for 2 years, and the rules may apply for a 2-year period, it's anywhere from 24 months to a year. It depends on the circumstances, but it could be as much as 24 months.
Okay, but it's not like 10 years. So
no,
you're looking at 2 years, which doesn't seem like a crazy length of time in terms of planning.
Right, and it's not, if it's sort of an ongoing thought for you, it's really not. And again, it doesn't have to be 24 months depending on the circumstances. It may be less. There's even more complications. There's something called safe income that only allows you to pay out certain money before a sale. So there's a whole bunch of complications. So really, what I would say, it's an ongoing process. So you don't even have to worry about that 2-year plan.
Okay.
Just always know that you're planning to ensure that you're going to qualify.
Okay. And what's the best way for people to reach you?
Probably the best way would be to go to my blog at the Blunt Bean Counter. And on that blog, I have a couple contacts, my actual Gmail account and also my account for Cunningham.
Okay, terrific. Thanks for dropping by, Mark.
Oh, you're welcome. Thank you very much.
Thanks for joining us for Tea at Taxevity. The Taxevity Insurance Advisory helps you understand insurance and bridges gaps in your coverage. There's no premium for peace of mind. How healthy is your insurance?